We're analyzing Salesforce stock ticker CRM to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Salesforce. Then we're giving a final rating to the business. This video is just over a 10-minute analysis. It's going to be intense, but it's going to be worth it. Before we get into these valuable metrics, let's understand Salesforce stock performance. Right now, Salesforce trades for $210.09 per share. Year to date, Salesforce is beating the market. Salesforce is up huge. Their stock is up 56%. They're among a handful of companies leading the S&P 500. In the last 5 years, Salesforce is compounding its stock at 9.5% annually. In the last decade, Salesforce is compounding at 18% annually. The company's stock is up nearly 5 times. Going back prior to the global financial crisis, in the last 18 years, Salesforce's stock compounds at 25% annually. Their stock price is up around 50 times. Right now, Salesforce trades $15 below their 52-week high. The company's up more than $70 from their 52-week low. Salesforce is a huge business. They have a $204.5 billion market cap. But the burning question is, why should we be paying close attention to Salesforce? Salesforce provides enterprise cloud computing solutions. The company offers customer relationship management technology that brings companies and customers together. Its Customer 360 platform helps the group to deliver a single source of truth, connecting customer data across systems, apps, and devices to help companies sell, service, market, and conduct commerce. It also operates Service Cloud for customer support, Marketing Cloud for digital marketing campaigns, Commerce Cloud as an e-commerce engine, the Salesforce platform which allows enterprises to build applications, and other solutions such as MuleSoft for data integration. Salesforce has made a number of high-profile software acquisitions, acquiring companies like Tableau, MuleSoft, and most recently Slack. Salesforce is also in the portfolio of a number of super investors. Rob Vinall, Josh Tarasoft, David Tepper, and Daniel Loeb all have positions in Salesforce. Now that we understand Salesforce, let's get into the numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. A typical business earns about 7% returns on capital. Looking for double this can build in safety based off the quality of the business. Salesforce has very low returns on capital. Part of this is how the calculation for return on capital is done. Historically, Salesforce has kept their earnings low while growing their revenues and their free cash flows. Their return on capital reflects more of their accounting than it does their actual business here. This can have tax implications for the business. Because of some of their accounting, this is an X on metric number 1. On paper, Salesforce earns about 1% returns on capital during this time. Metric number 2, we're looking for revenue, net income, and free cash flow growth. All 3 of these need to be up for this to be a check. We'll include their numbers up until today in our calculations. In this time, Salesforce has more than doubled their revenues. We learned their earnings can be kept low for accounting reasons. These have declined by 66%. However, by the same token, their free cash flows are up 2.5 times. It's great we're seeing this revenue and free cash flow growth. Free cash flows are ultimately how a business will be valued. We'll use a couple methods later in the video to do just that. However, because their earnings are down, this is another X on metric number 2. Metric number 3, we're looking at Salesforce from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. We learned Salesforce's earnings are down. They've also diluted shareholders by 28%, mainly for some of these acquisitions and share-based compensation. This is a 1-2 punch that lowers their earnings per share, meaning this is an X on metric number 3. So far, we're over 3, mainly due to Salesforce earnings. Does the company have what it takes to turn it around in the back half of our analysis? Metric number 4, we're looking for free cash flow per share growth. Here's where we start to see light for Salesforce. Their free cash flows have grown by a lot, up 2.5 times. This outpaces their dilution, meaning Salesforce grew their free cash flows per share. This is our first check of the day on metric number 4. During recessions, it's overly levered businesses that are at the greatest risk of poor outcomes. In metric number 5, we want Salesforce's net debt to be below the sum of their free cash flows in the last 5 years. Salesforce ended their last fiscal year with about $2.4 billion in net debt. Since then, they brought this down. Right now, they have a cash position on their balance sheet. In the last 5 years, when we add up all their free cash flows, Salesforce produced $22.2 billion worth. That would comfortably support their debt loads at any point during this time. Salesforce generates a lot of cash compared to the debt they use. This is another check on metric number 5. The big metric of them all, metric number 6, we want Salesforce average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury, Warren Buffett's preferred benchmark. It's the first of 2 different ways we'll estimate a fair value for Salesforce. Right now, Salesforce has a $204.5 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Salesforce similar to it being a private company. We just learned Salesforce produced $22.2 billion of free cash flow in the last 5 years, meaning in an average year, they produce about $4.4 billion of free cash flow. When that's divided by their enterprise value, it gives us a 2.1% average free cash flow to enterprise value yield. On a current basis, Salesforce produced $7 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, we get around a 3.4% current free cash flow to enterprise value yield. That one's about in line with the yield of the 10-year treasury, but both of these are down from the risk premium we're looking for, meaning this is an X on metric number 6. Don't just throw Salesforce out. We want to estimate a concrete fair value per share for Salesforce. We still need to estimate Salesforce's fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Salesforce, which takes us on to using a discounted cash flow model to estimate Salesforce's fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Salesforce has been pretty predictable in their past, starting with an average of their last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not for the business. Assuming Salesforce grows its 3-year free cash flows at a rate of 15% annually for the next 10 years, then in the following decade, this growth rate would be cut in half. Then we add in Salesforce's tangible book value, which gives an estimate of their net worth. If we're looking for a 15% rate of return, which is what Warren Buffett looks for, plus his margin of safety requirements, from today's valuations, an estimate of Salesforce's fair value per share is around $95. That's about half of their current stock price. There are key points to keep in mind. Salesforce has been a predictable business in its past. That's not a guarantee for the future. As the size of their business continues to increase, it's likely that these growth rates would slow down over time. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Salesforce, but we have to address something first. We've covered the numbers, but the qualitative factors of Salesforce may be even more important. What are they? Looking at the factors supporting a long thesis, number 1, management is likely going to focus on expanding margins after years of subscale profitability. Number 2, the company has added legs to its overall growth, including customer service, marketing automation, e-commerce, analytics, and artificial intelligence. Number 3, Salesforce.com dominates the SFA space, but still only controls 30% in a highly fragmented market that continues to grow double digits each year, suggesting there's still room to run. We'd be remiss if we didn't cover the negative factors as well. Looking at the factors supporting a short thesis, number 1, despite its size, Salesforce has generated substandard margins in recent years, and its renewed focus on profitability may negatively affect already slowing growth. Number 2, Salesforce has entered new areas via acquisition and has arguably paid high prices in the process. Integration risk is real, as is the risk of increasingly large, dilutive, or ill-conceived deals. Number 3, as the company grows larger, it may be increasingly difficult for Salesforce to grow faster than its various end markets. There you have it for a balanced perspective of some of the qualitative factors of Salesforce. Now it's time to give our rating. In analyzing Salesforce, stock ticker CRM, we've learned the company's grown their revenues and free cash flows by a lot. They've diluted shareholders in some big acquisitions, most recently acquiring Slack. Because their earnings are down and their margins may be suffering, the company has low returns on capital. Yet at the same time, they have a cash position on their balance sheet and they generate a lot of free cash flow. Salesforce is also owned by a number of value investors. It's worth reiterating this analysis is not financial advice. Salesforce's free cash flow to enterprise value yields don't look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, from today's valuations, using those assumptions, if you want a 15% rate of return, an estimate of Salesforce's fair value per share is around $95. That would see Salesforce's current stock price cut in half. It's $40 below their 52-week lows. Salesforce last traded at those levels in September of 2017. Looking at the factors of our analysis, Salesforce looks like a moderate candidate for further research. Again, this is not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Salesforce, and let me know what business to look at next in the comments below. Thanks for learning about Salesforce with me, and have a great day.